Visa just reported a really strong fiscal Q2. And honestly, this is one of those quarters where the business quality really shows up in the numbers. We're talking about net revenue up 17% year over year to $11.2 billion. GAAP is up 36% to 3.14s, and non-GAAP is up 20% to 3.31 SOS. For a smaller growth company, those numbers would be solid. For Visa, a company this large and this mature, that is genuinely impressive. And after the intro, make sure to hit the like button, subscribe if you enjoy these stock breakdowns, and comment below whether you think Visa is still attractive at today's valuation. Now, the big picture here is pretty straightforward. Visa is still growing at a double-digit rate, still producing massive margins, still generating a lot of free cash flow, and still buying back a huge amount of stock. Payments volume grew 9% on a constant currency basis. Processed transactions also grew 9%, reaching 66.1 billion transactions. Total cross-border volume grew 12%, and cross-border volume excluding intra-Europe grew 11%. Those are the numbers I really care about, because Visa's revenue growth is not just coming from accounting noise or one random segment. The core network is still seeing more payment volume, more transactions, and healthy international activity. And for Visa, cross-border is especially important because those transactions tend to be higher yielding. So when cross-border volume is still growing double digits, that usually tells us travel, international commerce, and global spending flows are still healthy enough to support the business. Revenue growth also came through across the main categories. Service revenue was up 13%. Data processing revenue was up 18%. International transaction revenue grew 10%. Other revenue jumped 41%. Now, client incentives also increased 14%. And those do offset gross revenue growth. But that is part of the Visa model. They pay incentives to win and retain business with issuers, merchants, and partners. So I would not look at that alone and say it is a problem. It is something to watch, but it is not unusual. The more interesting thing is expenses. GAAP operating expenses actually fell 4%, but that number needs context. A big reason for that decline was lower litigation provisions compared to last year. On a non-GAAP basis, operating expenses rose 17%, driven by higher personnel and marketing expenses. So the headline margin picture looks very clean, but underneath the surface, Visa is still spending to grow. That is not automatically bad. I actually think it makes sense for a company trying to expand beyond just the traditional card network, but investors should pay attention to whether that spending keeps translating into revenue growth and stronger competitive positioning. Because this quarter, Visa's profitability was still excellent. Operating income came in at $7.2 billion on $11.2 billion of net revenue. That works out to around a 64% GAAP operating margin. That is almost ridiculous. Very few companies in the world can operate at that kind of scale with that kind of margin profile and still grow revenue at 17%. This is the reason Visa has always been seen as one of the highest quality compounders in the market. It is asset light. It does not need to build factories. It does not carry inventory. It is not taking direct credit risk like a bank. It sits in the middle of global payment activity and earns fees as more transactions move across its network. That is a beautiful model. But the quarter was not just about the core business. Visa is also trying to show investors that it can stay relevant as payments change. Management talked about consumer payments, commercial and money movement solutions, value-added services, and the broader Visa as a service stack. This is an important part of the story. Visa does not want to be seen as just a card swipe company. It wants to be the infrastructure layer behind payments, fraud tools, analytics, authorization, identity, real-time money movement, and newer types of commerce. That is where value-added services come in. If Visa can sell more services around each transaction or become more deeply embedded in how businesses move money, then the long-term growth story becomes more durable. The company is no longer relying only on more card transactions. It is expanding the revenue opportunity around the network. Visa also mentioned agentic commerce and stablecoin capabilities. That sounds buzzwordy at first, but the strategic point matters. AI agents, stablecoins, embedded finance, digital wallets, real-time payments, all of these could change how money moves over time. For Visa, the risk is that some of these new rails bypass traditional card networks. The opportunity is that Visa becomes the trusted connector between new payment formats, merchants, banks, and consumers. So I do not think investors should assume stablecoins or AI commerce are huge financial drivers yet. That would be too aggressive. But strategically, I like that Visa is not just sitting back and pretending the payments world will never change. The company also completed the acquisition of Prisma and NewPay in Argentina. This is not some massive global needle mover by itself, but it fits the broader strategy. Prisma brings issuer processing for credit, debit, and prepaid cards, while NewPay adds real-time payment services, the Banelco ATM network, and a bill payment platform. So again, Visa is trying to deepen its role in local payment infrastructure, not just rely on the traditional global card network. Now, let's talk about cash flow and capital returns, because this is one of the cleanest parts of the thesis. Visa generated $3 billion of operating cash flow in Q2 and $9.8 billion year-to-date. Free cash flow was $2.6 billion for the quarter and $9 billion year-to-date. CapEx was only $761 million year-to-date. That is the magic of the business model. Visa does not need to reinvest a massive portion of its cash flow just to keep the machine running, so a lot of that cash can go back to shareholders. And this quarter, Visa returned $9.2 billion through buybacks and dividends. It bought back about 25 million shares at an average price of $320.66, spending $7.9 billion on repurchases. The board also authorized a new $20 billion multi-year buyback program. That is a big deal. The diluted share count dropped from 1.97 billion last year to 1.92 billion this quarter. So buybacks are not just a headline, they are actually reducing the share count and helping EPS growth. The balance sheet is also in good shape. Visa had $14.2 billion in cash, equivalents, and investment securities. Total debt was roughly $24 billion, including $1.6 billion of current maturities and $22.4 billion of long-term debt. Debt has increased, and the company did issue $3 billion of fixed-rate senior notes in February with maturities between 3 and 10 years. The rates were between 3.8% and 4.7%. But given Visa's cash generation, I do not see debt as a major concern right now. It is something to monitor, but this is not a highly leveraged company struggling to fund operations. This is a cash machine using a manageable balance sheet. Now, here is where the story gets a little less straightforward. Valuation, at around $334.86 per share, Visa's market cap is about $647 billion. The reported PE is roughly 31.4 times. Using Visa's own non-GAAP EPS numbers, the valuation looks a bit less expensive. Visa did 11.47 SOS of non-GAAP EPS in fiscal 2025 and 6.48 cents in the first half of fiscal 2026. That gives a rough trailing 12-month non-GAAP EPS number of about $12.44. At the current share price, that puts Visa at around 26.9 times trailing non-GAAP earnings. So depending on which earnings number you use, Visa is trading somewhere in the high 20s to low 30s earnings, multiple range. For an average business, that is expensive. For Visa, it is more understandable. This company has very high margins, global scale, low capital intensity, strong recurring transaction volume, and consistent buybacks. So yes, it deserves a premium. I do not think Visa should trade like a slow, mediocre company, but the price still matters. At this valuation, investors are not buying a cheap stock. They are buying a premium compounder where the market already expects strong execution. Visa probably needs to keep growing EPS at a low double-digit rate for the stock to work well from here, and management's outlook supports that, at least for now. For full-year fiscal 2026, Visa expects non-GAAP adjusted constant dollar net revenue growth in the low double-digit to low teens range. Operating expense growth is also expected in the low double-digit to low teens range. EPS growth is expected to be low teens. So the company is basically saying, the growth story is still intact, but we are also investing. For a 5-year investor, my base case would be something like this. Assume Visa can do around $13 of non-GAAP EPS in fiscal 2026? If EPS compounds at about 11% annually over 5 years, that gets you to roughly $21.90 of EPS by fiscal 2031. Apply a 25 times earnings multiple, and you get a projected share price of around $548, compared to today's price of $334.86. That is about 64% upside, or roughly a 10% annualized return before dividends. That is solid. It is not screaming cheap. It is not one of those situations where the market is completely mispricing the business. But for a high-quality compounder, a potential 10% annualized return before dividends is still attractive. In the bull case, if Visa keeps revenue growth in the low teens for longer, cross-border stays strong, value-added services become a bigger piece of the business. Stablecoin and agentic commerce initiatives actually add something meaningful, and buybacks remain aggressive. EPS could compound closer to 13% annually. Starting from $13 of EPS, that would get to about $23.90 in 5 years. Put a 30 times multiple on that, and the stock could be worth around $717. That would be roughly 114% upside from today. That is the version where Visa stays one of the market's best large-cap compounders and investors keep rewarding it with a premium multiple. The bear case is more about valuation and slower growth than business collapse. If consumer spending slows, cross-border weakens, regulation pressures card economics, alternative payment rails gain traction, and EPS only grows around 6% annually, then EPS might reach about $17.40 in 5 years. At an 18 times multiple, the stock would be worth around $313. That is about 7% downside from the current price. Now, that is not a disaster scenario. It is more like a great business wrong price scenario. A more severe regulatory or disruption case could be worse, but based on the assumptions here, the bear case is not catastrophic. The biggest risk, in my opinion, is regulation. Visa operates in a heavily scrutinized industry. Card fees, interchange economics, acceptance costs, network rules, these are always going to attract attention from regulators and merchants. Litigation is another part of that. Visa recorded a $311 million litigation provision this quarter related to interchange, multi-district litigation, and other legal matters. This is not new for Visa, but it does create noise and uncertainty. Then there is the alternative rails risk. Stablecoins, real-time payments, account-to-account transfers, closed-loop wallets, fintech platforms, and central bank-backed payment systems could all pressure card network economics over time. Visa is trying to participate in those shifts, which I think is the right move. But the risk does not disappear just because Visa has a strategy. There is also macro risk. If consumer spending slows, travel weakens, or global commerce cools off, Visa will feel it through lower volume growth. It does not take direct credit risk like a bank, but it is still tied to spending activity. And finally, valuation risk. Visa is an excellent company, but excellent companies can still disappoint investors if expectations are too high. So what should investors watch next quarter? First, revenue growth. Management guided for low double-digit Q3 revenue growth on a non-GAAP adjusted constant dollar basis, so I would want to see that hold up. Second, cross-border volume. That remains one of the most important high-yield growth drivers. Third, processed transactions. If Visa can keep transactions growing around that high single-digit range, the core thesis remains healthy. Fourth, expenses. Non-GAAP operating expenses grew 17% this quarter. So I want to see whether spending stays disciplined. And then I would watch value-added services, agentic commerce, stablecoin updates, buybacks, share count reduction, and any regulatory or litigation developments. So here is my final view. Visa is still a world-class business. This was a strong quarter. Revenue growth was excellent, EPS growth was strong, volume trends were healthy, and capital returns were aggressive. The long-term thesis is modestly improving because the core network remains strong, while Visa is also positioning itself for newer payment technologies. But the stock is not cheap. At a high 20s to low 30s earnings multiple, the market is already giving Visa credit for quality and durability. I would call the stock fairly valued to slightly expensive. For a 5-year investor, I still think Visa can work from here if EPS continues compounding at a low double-digit rate, but I would not call this a deep bargain, and I would not frame it as a high-risk, high-reward stock. This is more of a premium compounder, lower risk than many growth names, but also more moderate upside unless the newer initiatives become much more financially meaningful than expected. My overall rating would be neutral to bullish, medium risk, medium high confidence, great business, fair to slightly premium valuation. So for me, Visa remains attractive for investors who are comfortable paying up for quality, consistency, and long-term compounding. But if you are looking for a beaten-down bargain with massive upside from multiple expansion, this probably is not that. And that's my breakdown of Visa's fiscal Q2 2026 earnings. If you found this helpful, make sure to like the video, subscribe for more stock analysis, and comment below, would you buy Visa at this price, or would you wait for a better entry?